Okay, Mike, sorry about that. I cut you off, but I think everybody's on now.
Yes, sir. I think we're ready to go.
Was there something you need to remind me, or?
No, no, perfectly fine.
Very good. Okay. Hey, gang, this is Kurt Frankenberg, the founder of RadioActive Trading and author of The Blueprint. And I'm joined by my good friend and buddy, Mike Chepka over at Power Options. Say hello, Mike.
Good morning, everyone. I hope everyone enjoyed a nice holiday Valentine's weekend and ready to go back into the market and approach February expiration. And today, Kurt's going to present us with some unique insights into his revolutionary methodology to help us going forward over the next 5 months, 6 months, 12 months to a year. Isn't that right, Kurt?
That's right. Mike, we made some promises, right? I made some promises in the email that went out, and I think a lot of folks are here to see me make good on that. I said that there is a mathematical edge to trading with the married put over, of course, using a long call.
Mm-hmm.
And we're going to have to deliver on that. I'm going to have to make that good. But the room is still filling up, so let's give it just a few more minutes. We've got over 5 dozen folks coming in, and boop, just 2 more just popped in, 3 more. Okay. While that's going on, Mike, I'm going to go ahead and select one of our polls, and I'd like to know a little bit about the makeup of the audience. So, folks, take a look at this. If and help us know what applies to you. Okay, have you been involved with RadioActive Trading long? For example, do you own the blueprint already? If not, are you thinking about picking that up? Perhaps maybe you have seen some of the free materials like the sketch or the free YouTube videos. If you're answering that you've been to a live radioactive trading seminar, that's not this. We're not doing a live radioactive trading seminar right now. We're just doing one of our webinars that is instructional, but it's not the full-blown method. That takes about 12 hours to expound, doesn't it, Mike?
Yes, it does. Yes, it does.
So you may have been to a seminar that I've presented live, but I want to make sure that folks don't confuse that with what we're doing here today. Okay, let me go ahead, Mike. What were you going to say?
I was just going to say maybe you have some of the PhD professors from MIT that still join our general presentations. You know, maybe that's what they're thinking of. That counts as a live seminar as well.
Right. Yes. When I presented there, that was certainly a live seminar. We got that one done in 6.5 hours, but everybody's pretty savvy with options investing at that one. Okay, let me go ahead and close that mic and share the results. It looks like our winner today is folks that are thinking about buying the blueprint, but we've got a lot of folks that already own it, and that's marvelous. Okay, just a few have done some of the Mastery Series CDs, and those are simply they're animated versions of the blueprint, or actually chapters in the blueprint where we kind of expound. Okay. So second place here is folks that have read the sketch or done maybe some other of our free educational materials, and of course that's part of the mission. We want to make sure that folks have access to that. Okay, and we have 15% that have been to a live radioactive trading seminar. That's marvelous. Okay, let me go ahead and hide that, Mike, and let's make our introductions real brief. Okay.
Okay.
This is me. Actually, that's not a picture of me. That's that's a picture I got off the internet. But and you can see my picture at RadioActiveTrading.com. I'm the handsome bald guy on there, and you can't tell that I'm really short by the picture. So, but anyway, I've owned a martial arts studio since 1986. So I guess now that makes it 24 years. I've been doing this punching and kicking game. And along the way, I got into trading, and about 10 years ago, I had my butt handed to me by the market. And I should have known better, Mike. I should have known that, the person in the ring that has the best chance is not the one that can deal the terrible blow. It's the one that can take a terrible blow and still be smiling because he had his hands up. He had good protection. And so anyway, I should have taken that into the market, but I didn't. I didn't understand about how to manage risk, and now I do. And so that's my mission, is to get that to as many folks as possible. Mike, let's hear a little bit about you and how you got involved with RadioActive Trading, and then we'll blast right into the presentation.
Well, fantastic, Kurt. I've been a member of the staff here at Power Options for over 7 years. Power Options is a suite of tools designed for self-directed options investors. We support over 23 different option strategies, search tools, patented search and analysis tools. I handle a lot of the coaching sessions, a lot of the education on the website, and I'm versed in all 23 strategies on Power Options. About 2 years ago, I had one of my customers call me up and ask me about some of the backtesting features that we offer on Power Options regarding the married put trades. And I spent half an hour, 45 minutes with that gentleman going over some of the ideas and the concepts, and then he invited me to attend one of his free webinars about his unique trading methodology. Well, I went to the first webinar, and then I invited Ernie Zarenner, the president and founder of Power Options, to join me for the next two. And Ernie, who'd been trading covered calls and other strategies for about 20 to 25 years, was so impressed with this methodology, which is, of course, the radioactive trading methodology that we're going to learn a little bit about today, that we at Power Options decided to partner up with Kurt, enhance our married put tools and our portfolio tools to work with Kurt's methodology, and essentially join forces to share this methodology. And we feel that most investors should be trading to protect themselves and avoid some of the things that you experienced early on, Kurt.
That's right. And of course, that person that called you turns out to be me, right, Mike?
Oh, of course, yes, that's right.
I was really pleased with my experience as a customer with Power Options. I'm even more pleased with partnering with y'all, and appreciate your presence here. Well, Mike, we gave a couple of tall orders. I said that I was going to prove the mathematical edge that that married puts provide to the trader over a long call, and I'm going to go ahead and deliver on that. But we still have had, oh gosh, I think another dozen folks came in the room in the last few moments. So let me just do one more poll of our audience and ask you what your level of options investing is right now. Okay, what kinds of options trading are you doing right now? And this is a poll that you can answer more than one answer, just like the last one. You can choose more than one answer. For example, if you do long calls and puts and you'd like to know what advantages that might have over covered calls or spread trades might have over naked puts and so forth, then go ahead and put her in there. Mike, we're having an unprecedented number of folks today. I mean, normally, gosh, we've had as many as 700 or 800 folks in the room at one time. But that's usually when we're doing a special webinar. And this is just one of our twice-weekly dealies.
But it is a little special. We're doing some new material, and this is new material that I haven't seen either, folks. So I'm going to be learning with you today when Kurt presents.
Very good. Okay, Mike, I think that poll's been up there nearly a minute, so I'll go ahead and share it.
Okay.
And boom. Can you guys see that? That's
right. Yeah, it just came up, Kurt.
Okay, good. 7% say options mean a likey, and I'm going to tell you that I understand that. Usually, if you don't like options, it's because of one of two things. One is that you don't understand them, okay, and that's understandable that you wouldn't want to say that you like options if you don't know what they're about.
Right.
But the second reason, and more common reason, is folks that have tried out options have gotten burned. And that goes back to the first reasons. It may have been because of not understanding them. Okay. Mike, the cure to both is education, and that's what Radioactive Trading endeavors to do, both on the free pages and lectures and things that we do, but also, of course, in the paid stuff, and we're going to plug that a little bit today. But our main purpose here today is to educate, and we're going to educate and do that for free. So, okay, let's see. Our winner here today, Mike, is long calls and puts, and that's good because guess what? We're getting ready to show what is the advantage of trading a married put over trading a long call, and I think that's what a lot of folks are here for. So we'll go ahead and hide that. All right, very good. Real quick, let's see. Just want to mention why I'm here. I made some good money trading stocks, and I lost it all in one bad trade because of not understanding risk management. Made up my mind to never allow that to happen again. And while studying the lives of great traders, I ended up coming across what I'm going to call the holy grail of trading. Now, I'm not going to say that radioactive trading is necessarily the holy grail, okay? But what I am going to say is that risk management is the holy grail of trading. Rather than just trying to pick the right stocks, or rather than just trying to time the market, it's important to manage your losses more than anything else. And that's the one thing that I found in common between all great traders, was that they were fanatical about keeping their losses low. Okay? And so anyway, it's my mission. This is what I do. I lecture all over the country, teaching about how to stay out of trouble. And I think it's very important. We give away the very best parts of the system. We're going to give it away today. All right, and then if you want more support and so forth, we are going to give a little plug at the end. Okay?
Okay.
All right, good. Mike, I'm going to jump out of this presentation and jump into the one that I promised, and that today was, here we are. Hang on, I think that's the right one. Nope, that's not it. We've got a couple of different things to show. Okay, we're going to share the mathematical edge that married put trading has over a long call. Okay, it's a distinct mathematical advantage, and but first a little review of radioactive trading principles. Okay, first of all, when we trade options, we want to try and buy options that are further out in expiration.
Mm-hmm.
Why is that, Mike? Oh,
Well,
we just topped 100. So we've got 100 attendees. Okay,
well,
go ahead, Mike.
Yeah, the reason we're going to buy options further out in time is that the increase in price for time on a call or a put option is not linear. What I mean by that is that if I'm looking at two of the same strike options, if I buy something that's 6 months out in time, I'm not going to pay 6 times the cost. In addition to that, what you're referring to here is the red line, is the options that are further out in time will cost me less per day than the near-term options, but we also won't suffer a rapid time decay. The time decay of our far-out option usually won't hit until the last 30 to 60 days before the expiration of that option.
That's right. The reason that I determined to call this style of trading radioactive trading is because this line here is analogous to the line, the curve rather, of the decay of a radioactive element. As a radioactive element decays, okay, it begins very slowly and then accelerates with time. Here's a 30-day. If you were to buy a 30-day option, you might expect to pay $1. But the same strike price, okay, the same strike price with the same underlying instrument, you might pay $1.87. Let's just say $1.80, okay, for 90 days out, okay? So if you're paying $1 for 30 days, or you're paying $1.80 for 90 days, well, what's the better deal?
Well,
the further out one.
The further out one, that's right, yeah.
Okay, so this is one of the principles of radioactive trading, okay? Now the next principle about radioactive trading is what we call the ATM bell curve, or at-the-money bell curve. Mike, the pricing of options, if it's deep in the money, whether it's a put option or a call option, or it's far out of the money, the time value portion of that pricing is very low. But at the money, it swells. It's very high. And it's this principle that we base all the income methods off of. All right? Pardon me. But probably the most important principle of radioactive trading is that we force ideal-sized trades. Now, let's talk about that a little bit, Mike. If I were to come to you and say, Mike, I made 100% return on one of my investments, you'd say, well, that's great. But then what's the next question you probably ask me?
Well, how much did you invest to begin with? Did you make 100% off of a $10 investment, or did you make 100% off of a $10,000 investment?
That's right. Okay, that's usually what's going to happen. And the thing is if we risk too much, okay, if Mike, what if I was to come to you and say, geez, I just lost $10,000. Wow. The next question is, well, geez, how much of that was your account? If my account was $10,000 and I just lost $10,000, that's total ruin, right?
Yes, it is. Mm-hmm.
But if my account is, $2 million, then losing $10,000, that's like the cost of doing business. I mean, sometimes that'll happen. Sometimes you'll be up 10,000. Sometimes you'll be down 10,000. It's not that big a deal. And here's the important part to understand, that we need to risk just the right amount. If we risk too little, then when we have a gain, it doesn't matter overall. Okay? Mm-hmm. If I have $10,000 and I double my money, but I double my money on only 5 of those $10,000, just $5, well, that doesn't make a very big difference overall to the account. On the other hand, if I risk the whole account and lose half of it, that's too big of a risk to take, okay? So this one principle of radioactive trading is probably the defining principles. I like to say, instead of picking stocks, let's pick stops. In any game of chance, there's a wager that's too small to make a difference if you win, and there's also a wager that's too large because of the risk of ruin. And that's why this central principle is so important, okay? Now, it's my contention, and I've been proving this, Mike, for years and years, and it was part of the topic of my lecture at MIT, was that the market itself will tell you how much to risk in any one position, if you allow it to, okay? And I've heard this argument before, and I'm going to say, no, it's not true, okay? Mike, have you heard this, that a long call is identical to a married put?
Yes, I never, of course, like to use the term identical, because no two positions, in my opinion, are ever identical. There are some things that are referred to as parity trades as one another, such as naked puts, for example, and covered calls. But the greatest thing that we always hear, Kurt, isn't it, is that the long call is identical but better to a married put, right?
Right, it's identical but better. What does that mean?
Well, it's an oxymoron, isn't it?
Yeah, it sure is an oxymoron, kind of like military intelligence or Microsoft Works, Mm-hmm. It's a self-contradicting statement. Okay, so anyway, a long call is not identical to married put. Let me ask you this, Mike. If you were to place a married put trade, right, where you put up $10,000 to buy stock and you put up another $5,000 to buy the put option that insures it, mm-hmm. but instead of being delivered that, you were delivered a long call option, would you be happy?
Well, no, I wouldn't, because I was buying the stock for a specific reason. I wanted to own stock, whether I wanted to take advantage of the dividend, or maybe I wanted a one delta, on the underlying stock position. If my broker filled me with a long call, I would not be happy.
Yeah. One of the reasons you wouldn't be happy is that you'd be missing a lot of capital, wouldn't you?
That's right.
All right. So they're not identical. If they were identical, they'd be interchangeable, but they are not interchangeable. Okay. Now here is how they're similar. All right. If we look at the risk-reward graph. All right. First of all, it is a bullish strategy. Secondly, it is safer. Right. And thirdly, the reward is potentially unlimited. All right. We look at the protective put and the long call graph, and it looks almost identical. All right, but there is a parity, okay, but I want to show you something, okay? Mike, can you see the screen okay? I'm looking at, and you can do this on just about any issue. If you go out, this is, the January 10 calls, but I did this in 2008. All right, if you go out a couple of years, all right, and you look at any strike of put, okay? Right over here, we're looking at the $65 strike on Amgen, all right? If you buy the call, over here on the left is the call. So if you buy the call, it's bidding at 525 by 545. You might get filled right in the middle. Let's just say you buy the call at 535. You get a good deal on it.
Okay.
Okay. All right. Well, how much do you have at risk if you buy one call?
Well, you've got $535, your full investment. That call could expire worthless, and you could lose all the premium.
Right. Okay. So let's go on over here to the right, and it's going to take a little bit more because if we buy the stock at 55.40 and also buy a put option at say the $65 strike at $14.65. Okay. Looky over here, Mike. How much of that investment would be at risk? Would it be the whole amount, or would it be just the time value of that particular investment?
Well, it's just the time value because the intrinsic value is covered by the purchase of that put option. You've essentially bought an insurance policy that's higher than the current stock price. Now, yes, you paid a little bit extra for that, but all you're risking is the time value, the $4.98 there, not the full $15. Or I'm sorry,
Okay.
$14.40-ish.
That's right. So here's how it breaks down. Okay, the long call itself would risk $5.45, right?
Mm-hmm.
Okay, if you had that position, all right, if you buy the $65 call. Now, if we buy the stock and the $65 put option, why then the total amount at risk is going to be less. Okay, look at that.
Mm-hmm.
That's interesting. Now, I use the ask prices on both of these. All right, I use the ask price on the call, and I use the ask price on the put, and that's exactly what we can expect to be filled with. You probably could do better buying the call, but you know what? You could also probably do better buying the put, couldn't you? If you could get it 10 cents under the ask, then this would be an even better number. But the point is, Mike, are these different numbers?
Yes, they are.
Yeah, there's a different amount at risk. Now, I've had some folks say to me, well, wait a minute, that can't be right, because if you could do that, okay, then you could buy one and short the other and have an arbitrage trade, and that can't be. And Mike, the fact is that you can do that. You can buy the married put and then short the call and have an arbitrage trade. But the thing is, the difference here is 50 cents. Okay, the difference here is exactly 50 cents. And 50 cents for an investment of $69.95 and holding it for a couple of years, you know what that equates out to?
What would that?
It equates out to the risk-free interest rate.
Okay.
Yeah, you see, my critics have said, well, geez, there's no difference. Well, yeah, there is a difference, and they've also said, well, geez, if what you're saying is true, if there's a mathematical edge to buying a married put, why then you could buy a married put and then sell a call, and make money for free. And the fact is, yeah, you can make money for free. You just can't make a lot.
Sure.
You're not going to make a whole lot, okay? But it is there, okay? Can a long call and a married put be used similarly? Yes, but it's very important to understand, and even more important to practice position sizing. Now, Mike, I'm showing a chart here of an unfortunate soul. Do you remember this illustration that we used to do?
I do. It's been a year since I've seen this.
I haven't been sharing this for a while, but I actually had somebody that went to a gosh, should we use a name? I won't use the name.
Nah.
Okay, but there was a fellow out there that was saying that it's a wealth option to buy calls and then sell calls against. And so what he did was he recommended Boston Scientific, BSX, and what this fellow did that called me. He got into the $12, it was the January 09 $12.50 call option. Now at the time, Boston Scientific was trading at $18. So Mike, that was a deep in the money call, right?
Yes. Mm-hmm.
Right. And what he did was he picked up 35 contracts. Well, over the next couple of years, he's fighting two things. Number one, he's fighting the time decay on the option. But what else is he fighting?
Well, he's fighting a declining stock price, isn't he?
Right. At the point where he called me while BSX was basing in here, and he says, "What should I do?" And I said, "Well, I don't have a lot of wisdom because I would never be in a position like this. I would never have bought 35 long calls. What gave you the idea to do that? And he said, well, I mean, that's what they teach. You buy these long calls and you sell calls against, and you make money. I said, well, where are you at so far? He says, I'm down 87%. I said,
Right.
okay. At that point, I would sell. I said, well, I don't know. It might come back. And then, of course, the rest of the story. Okay, it just got worse and worse. And he ended up losing most of his investment. Okay, well, if you're going to trade long calls, you need to use only a small percent of your account. The Black-Scholes equation assumes that if you buy a call, Mike, what does it assume?
Well, it assumes that you're only going to put a certain amount in place for the call position, and then you're going to put a sort of, what I use the term commensurate, that's not always the best term, but I'm putting another amount aside to hold on deposit to sort of mimic buying the stock itself. The money that I would use to buy the stock, I've put aside in an account.
That's right. You see, the thing is, the Black-Scholes equation assumes that you have the capital to buy the stock, but instead of buying the stock, you buy the call and put the rest, what did I say? The rest into an interest-bearing instrument. And not everybody is teaching that. Not everybody is saying, look, you should only trade as many long calls as you could afford if you were buying the stock. All right? And then the rest should go into an interest-bearing instrument, okay? Well, the thing is that when you buy a married put, okay, that is priced in. It's priced in. Okay, when we do a true synthetic equivalent, okay, the true synthetic equivalent of the long call is not the married put. The true synthetic equivalent is the long call plus as much cash as it would take to buy the stock anyway, put away and bearing interest. But not everybody does that, do they? Not everybody does that. Okay, let me go ahead and ask a poll here, okay? Over the last 12 months, now we had, was it 80% doing long calls and puts?
79, so yeah, well, let's just round up, say 80%.
79% doing long calls. So over the last 12 months, are you happy with your trading results? And this is going to include folks other than the long call traders. Okay, but let's just see what, what our level of satisfaction has been trading that way. Mike, this is shaping up pretty much the way we normally see, isn't it?
Okay, that's interesting.
Yeah, 80%, well, 79% of our attendees today trade long calls and puts. Okay, now let's go ahead and close this. It's been up about another, well, let me leave it for another 10 seconds or so. Okay, we'll go ahead and close it and then share the results. Okay, Mike, what do you see?
Well, you see what we normally... Yeah, that is up there, Kurt. We have our 24% mixed emotions, our... excuse me, Kurt, I apologize. Our 60% saying no and 16% saying yes, they were happy with their results.
Right. 16% are happy with their results, and that's with most of us trading long calls. Well, geez, I'm going to venture to say that maybe one of the reasons that we're not happy is that we're losing money. Do you think that'd be a safe bet?
I think that'd be a pretty good bet, Kurt. Absolutely.
Okay, and maybe if we were able to control some of those losses, or make those losses when we do have a loss, make them really small, then that would be a good way to go. Perhaps if we traded less contracts, or we traded only as many contracts, and perhaps if we had an edge when we buy. Now, let me go ahead and hide those results here, Mike. The true synthetic equivalent of a married put is not a long call, is it? The true synthetic equivalent of a married put, when you buy a married put, you spend most of your money on the shares of stock and a little bit on the time value of the put. Okay? And then that is equivalent to the same strike call over here, but only if you take the rest of your capital and you deposit it, and that's a lot of capital, isn't it?
Oh, yes. Yes.
All right. So here's the deal, okay? If you deposit the amount of money it would take to buy the stock and buy one call contract, that would force an optimum position size. Okay, and if you have the discipline to put the lion's share of your capital into an interest-bearing account, why then that would be the way to go. Okay, but not everybody does that. Not everybody remembers to do that. By trading a married put, first of all, we'll go back just a little bit. First of all, the interest that the Black-Scholes equation assumes that you have, that you are going to earn because you have made a deposit in an interest-bearing account, that amount is priced into the long put. Isn't that something? When you buy the stock and you buy the put, now Mike, let me just ask you a question. When would you rather have your interest, a year from today or today?
No, we'd rather have it today, of course, Kurt, wouldn't you?
Yeah, and that's the edge. That's the edge that I promised everybody that's at this presentation today. Okay, you're going to, by buying your stock and a put instead of buying long calls. All right, first of all, you're going to force yourself not to trade too many contracts. But secondly, you're going to have this slight pricing edge, and 50 cents makes a difference. Maybe it's not a huge difference, but it does make a difference. It's a slight edge to begin with, and you won't trade too many contracts either, and that's really the core of RadioActive Trading. You know what? Let me just ask, okay, what single thing does everybody out there think that they need to be more successful at trading? What single thing? Okay, we don't have a lot of votes in yet, but all of them are limit my losses more so far. Okay, we've got a couple other answers going on. Let me leave this up for another 10 seconds. I figured that folks are learning how to use that poll tool, and they'll be able to get their answers in quickly. Okay. Mike, here we go. Let me just share those results. Do you see those up there?
Yes, sir, I do. Wow. I think people know what you're trying to say, Kurt. I don't know.
We just want to limit our losses more. And you know what? If we limit our losses more, the wins are going to take care of themselves. Okay? We're going to go back to our regular presentation, but I'd like to mention something. You know, if you lose 50% of your account, Mike, lose 50% of your account, what do you need to make on your next trade to be back up to even?
If I lose 50% in my account, Kurt, I'm going to need a 100% gain on what I have left just to get back to break even.
Okay, now let's go more modest, okay? If you had a 5% loss, well, if a 50% loss means that you need to have a 100% gain, you need to double your money, all right? Why then, what does a 5% loss mean?
Well, if I apply mathematics and just divide by 10, that would mean I would need a 10% gain just to get back to break even. But that's not how things work, is it, Kurt?
Yeah, that's not really how it works. You only need a 5.26% gain. You see, Mike, if you keep your losses low enough when you do lose, then you don't need as big a win to get ahead. And that's one of the most important lessons of RadioActive Trading. Okay, Mike, I'm going to go back to this one here, this presentation. And I'd like to open it up to a couple of questions because I know a lot of folks came on wanting to know about the mathematical edge. Do we have any questions about that before we move on? And then what we're going to do is get into some of the income methods, for example, of RadioActive Trading. Okay? Oh, I got to hide that. You got to remember that. Do we have any questions coming in?
Well, we had a couple questions from Barry regarding the blueprint. I answered those. John right now is having some issues with his sound. I'm working on that, but I haven't seen any other questions come in yet, Kurt.
Okay, and we're pretty solid with our attendee list. Okay, so that tells me that we're keeping everyone's interest. I'm going to ask this question here. Did we have something come up?
Yeah.
Okay.
What? Oh, I'm sorry. I just got a question. I think it's from Imran. Is what are trade-offs for put plus call at the same strike? I think he's referring to a long straddle. I'm not sure exactly what he's asking there.
Yeah, okay, maybe submit that question to support at RadioActive Trading,
Oops.
and we'll get back to you.
Oh, wait.
What we're talking
Okay,
about
hold on.
today is married puts.
Yeah, Imran said yes, and Imran, I'll look up your email later, and I'll show you some examples we have where past radioactive customers have asked about using a long call instead of the stock with a protective put, and it just never works out right, and I'll send you some examples of that. Mark just came in and wanted to know, what is the profit potential for the married put strategy? Well, it's technically unlimited, isn't it, Kurt?
It is unlimited. Let me let's talk about that, okay? Mike, do you see the covered call screen there?
Mm-hmm.
Now, we've done polls before where we've asked folks, okay, look, who's making the 3 to 5% per month that they were promised? And we haven't had any takers yet. We've had a whole lot of folks say, well, I've heard of others doing it, but I've never done it. And all these folks seem to go to the same $3,000 weekend seminar, okay? So here's why I'm going to say that that's happening, okay? Because covered call selling, there's nothing wrong with it except for what's wrong with it. What's wrong with it is if you buy stock and hedge it with a call option, Mike, that's mixing strategies, right?
Yeah, we're taking a bullish strategy and adding a bearish strategy, aren't we?
Yeah, and there's nothing wrong with that except for what's wrong with it. What's wrong with this one is that if the stock goes down, we're still holding the stock, right? Some folks that are listening are familiar with this heartache. Okay, you own the stock and you sell the call, and then the stock goes down. But what's the other heartache? You tell me.
Well, it's a sorting machine, isn't it, Kurt? When we're trading consistently with covered calls positions in various markets, what we find out over time is that the losers end up staying with us for significant losses, and the winners get called away from us from a modest gain. If the stock went up 10 or 15%, we don't take advantage of that, do we, Kurt? We get called out for the 3 or 4% gain.
That's right. I'm going to put up an example here in just a few minutes where we had somebody come on and they said, man, I made 7.9% in a month with a covered call trade, and you're telling me a married put would have done better? And I wrote her back. I said, well, yeah. Tell me the date that you bought it, and I'll apply the same I'll apply what's in the blueprint to it, and we'll just see. Okay, so I'll deliver on that here in just a minute. But let's just look at this hockey stick graph. Only we're going to turn it upside down, which to me is actually right side up. All right, Mike. Here we've limited our losses. Right, we have a theoretical unlimited gain. As that stock wants to continue up, we can continue making money. Talk about what's different between the radioactive profit machine. That's my brand. Okay, it's my way of describing my kind of married put setup. Let's talk about the difference between what we're looking at and a traditional married put.
Well, we discussed this a little bit earlier, but any of you out there who've read an Introduction to Options Investment book, or maybe you've read some information or education at your broker, you've probably read that a married put or a protective put is defined as buying stock and at the same time buying a put option that's below the current stock price, that's out of the money, and maybe only 1 month out in time. So you're only paying 80 cents or 50 cents for the put. But the problem is that since your put is below the stock price, you may have a drop of 10 or 15% before the insurance policy kicks in. You have a 15% gain, or I'm sorry, 15% loss. You might need as much as a 22% gain or so to get back to break even. That's very hard to swallow. What you've done here, Kurt, is you've reversed both concepts of that general position, haven't you?
Right. You see, we entered this, I think, in February or March of last year, where we bought the shares of SY and also a put option that was 5-6 months out in time. Okay. So when you buy the put option out in time, it gives you a longer time for that position to mature. Another thing, too, is that most of this $590, that looks expensive, doesn't it? But most of it is guaranteed back to me. If we add the two of these together, we get a sum of $36.61. But see, I've got a $35 put, which gives me the right, not the obligation, but the right to sell that stock at $35 if something disastrous happens. So the $161, that's the difference. That's the only amount that's at risk. $161 divided by $36.61 is single-digit risk. Look at that. We've got 4.4% at risk, and yet an unlimited profit potential. Now, Mike, added to this, we can do other things, right? I mean, we can sell the calls against it, for example, that are in the near term, and dissolve some of that risk. For example, the put that we looked at was a September put, but we could sell the June 35s for 90 cents and then take out half the risk. All right, this is one of several different income methods. So that's possibility number 2, is we can take away even the risk that we have at the front end using different income method strategies, and we've got 10 of them. All right, selling covered calls is pretty commonly known, so I give that away for free, but there's 10 different adjustments. We're going to show another one a little bit later. Okay, I'm going to ask folks, which of these would you rather know? Because we've got a limited amount of time. Would you like to know how to bulletproof a stock before an earnings announcement? Would you like to know how to make money on a stock even if you're wrong about its direction? Or would you like to make money even if you're wrong more often than you're right? And Mike, let's just kind of look at the first few answers and decide which of these 3 we want to do. Got a couple of folks writing in.
I'm still going through some of the other questions. I gotta go back down here and go scroll through everything. Pete says bulletproof. Tom says number 3. Oh, geez, all 3, Jim. Number 1 is Imran. Number 3, 1 and 2, 3, 2, number 1, 2, 2, number 1. I don't know what you want to do here, Kurt. Seems pretty even all over the board.
Okay, here's what we're going to do. Okay, I'm going to go ahead and make good on the promises. We've already shown how a married put can be superior to a call option mathematically. Okay, so I want to go ahead and we'll show how to bulletproof before an earnings announcement. Okay. Let's do that. While I'm calling up that particular deal, I'm going to launch another poll. Okay, let's think about that. Are you happy with your trading results from last year? Let's think about that question again, but let's pose it a little differently. If you had kept your losses down to single digits, say 5-6%, but also kept your gains, would that have changed your answer? Okay, and while that's happening, Mike, I'll go ahead and pull up the presentation that shows spread trades after the fact. Okay. Okay. Wow, this is pretty intense. If you kept your losses to 6% or less, but kept your gains also, would you have answered differently? And Mike, what was the percentage of folks that said yes before I'm happy with my trading?
Oh, shoot, I think it was 16%, if I'm not mistaken.
Okay, you know what? We've actually had a flip-flop. Let me go ahead and share the results. It would go the other way. We'd have almost everyone happy with their trading, 84%, and then 16 less satisfied. 66% would have said, yes, I'm happy with my trading results. That's a little bit better than 16, wouldn't you say?
Oh, absolutely.
And 19% say, I would have still said no, but been closer to yes. All right, and then 16% would have still said no. Now that looks like it adds up to 101%, but I think that's because of rounding off in the poll feature. Okay, but Mike, let's put a dollar amount to that, and then I'll go ahead and share income method number 3. Okay, let's put a dollar amount on that. Okay, if you look back over the last year, and if you limited your losses whenever you did have a loss down to 6% of that particular trade or less. On the other hand, you're able to keep your gains. How much would that have changed your overall picture? Interesting. So far, nobody has answered that they can't see how forced position sizing could even help them. Nobody said that. So I'm thinking the 16% that wouldn't have been happy with their trade, they just wouldn't have been happy enough, right? Okay. Let me go ahead and share these results. Mike, the lion's share, 62%, would have saved or made $5,000 or more if they only had the free information that we've given away today, a year ago. All right. Listen, folks, I actually got a lot of thank you letters in October and November last year. And the reason was that while mutual funds were down 40, 50%, folks that were following my methods were down single digits. They were down 4 or 5%. Okay, and guess what they were doing at the bottom? Mike, they were buying.
Right.
And without fear, because they knew that they had an unlimited upside potential position, and yet very little at risk, single-digit risk. Okay? All right, let's go ahead and hide that. And we're going to show that adjustment, one way of becoming bulletproof before an earnings announcement. Okay, now what the problem is with stock trading is that you don't know what's going to happen next, right? I mean, there's on this chart, there's plenty of places to buy or sell and make a profit, all right? But the problem is that we don't know what's going to happen next. And honestly, if we could know what was going to happen next, then there wouldn't be a market, all right? It would be priced in, okay? So bulletproofing is the nomenclature that I use when your cost basis is less than what the strike of your put is, okay? When your cost basis is less than what the strike of your put is, then you're bulletproof. And you can be bulletproof and your stock can continue to go up. Well, one way to achieve that, of course, Mike, is to sell short-term calls against a long-term married put. And that's actually, we've got a lot of copycats out there that are now catching on and showing that. I've been teaching the married put and adjustments to it since 2002. And very recently, we've had a whole lot of folks, probably folks that are here today have been to some of these presentations. They usually do them in the evenings. But Mike, we're going to show something completely different. Okay, this doesn't involve selling calls at all. So, and I've done income method number 3. I call this income method 3. I've done income method 3 recently, but I like to show this research in motion example. And the reason for that is that research in motion gapped down about 3 or 4 months ago. It had a gap down, overnight gap of 35-40%. Just, one day it's trading at, I don't know, I think it was trading at 90, and the next day it was trading at 55 or something.
Right.
Ridiculous. Okay, but let's go ahead and take a look here at Research in Motion. This is an actual real dollar trade that I did. I picked up Research in Motion at $84.04 a share. At the same time, Mike, if I were doing the covered call strategy, that day I could have sold the October $85 call. And now, is that consistent with what most of the gurus are teaching about selling covered calls?
Yeah, I mean, we're in September. You might not want to sell the September call because it's too short term. Look out to October. And as we saw with that ATM bell curve, we want to keep the strike price close to at the money potentially, because that not only that gives us a good time premium, the highest time premium available on the chain, but it also gives us a slightly better probability than selling a far out of the money call.
That's right. Okay. Now, here's what would happen when you do income methods, and I consider selling a call an income method because it's done at a credit. All right. When you do an income method, you reduce the cost basis, right? So your cost basis on your stock would be $77.94, and then of course if the stock goes up, you deliver it at 85. All right. So you make the profit. The difference is a profit, $7.06. Now, $7.06 out of $77.94, that's pretty healthy, isn't it? It's approaching 10%. It's like about a 9% profit, okay? But, Mike, that isn't what I did. I did income method number 3. Now, let's take a look, because before I can do income method 3, I have to have my insurance policy in place. So here I'm buying Research in Motion, $84.04, and at the same time, I purchased a January 09. Now, remember, this is 07 that I'm doing this. But I bought a January 09 $100 put option for $24.70. Well, that makes my total invested amount $108.74. I have forced myself to only buy one position. Okay, so I was trading a 6-figure account, but I only wanted to put, I was diversified among 11 positions. Okay, and so I only had about $11,000 to put in this particular trade. So I've limited myself to just one contract, one put contract in 100 shares of stock. But look at what happens here, Mike. I've got the guaranteed exit of $100 if something really bad happens to Research in Motion.
Mm-hmm.
Well, usually I like to risk only 5-6%. This particular stock, an earnings announcement was coming up, and I knew that if it went up, it'd go up real good. And so I made my at-risk amount actually as high as I really like to go, and that's 8%. Okay? So I've got an 8% risk in this radioactive profit machine. All right? Now, here's what happens. Okay, the market goes up. Research in Motion begins to approach $100 a share. Okay, and 3 weeks into the position, I did a put spread. Now, some folks will be thinking, well, geez, I can't sell a put against a put or whatever in my IRA. Well, listen, you could do this in your IRA. I promise you. I sold to close the January 09 put that I'm holding, and simultaneously bought to open. In my Options Express account, this was one commission. Okay, it was $9.95, one commission to trade this. Okay, I bought to open in October 07, $100 put. Okay, both of these are $100 puts. I guess I should put that up there. They're both $100 puts. So it's the same strike, but different expiration months. Now, Mike, is that a credit or a debit?
You've generated a credit here, Kurt, because you've sold to close your initial put at $19.80, and you bought to open the second one for only $7.20. So you took in $12.60 right now.
Right. Now, some folks are going to miss this. It's not going to compute for them. They're going to say, wait, you lost on the put. Yes and no, okay, because the stock advanced $16 for my put to go down $4.90. Okay? The stock advanced, the put goes down. I don't care. I'm long on both. Mike, if I took $4.90 out of your pocket, would that be okay with you?
Well, I'd question as to what your motives were without just taking money out of my pocket without asking, sir.
Okay, well, if I took the $4.90 and said, hey, thanks, I just want exact change for something, here's a $20 bill.
Oh, I think I'd be okay with that transaction. I don't know if you would be or your wife would be, but I would be.
Yeah, and if I did it 100 times in a row, you'd be really happy. Well, that's exactly what the market did. But here's what I did. I took that put and I swapped it for another cheaper put and generated a credit of $12.60. Now let's look at what that does to our net position. The net position that I started with is I've got stock for $84.04. Okay, I've got the put option for $24.70. Okay, we add those together. This is my initial cost basis. There we go. Initial cost basis is $108.74. Then I did income method 3. I could only do income method 3 after the stock changed and the time value of my put also changed. Okay? But the spread brought in $12.60. Now, Mike, if I swapped one put for another, do I still have the $100 put option?
Yes, you still have an insurance policy in place at the 100 strike.
It just has a nearer expiration, right?
Correct.
Okay, so the $108.74 that I spent minus this spread, okay, equals a new cost basis of $96.14, but I'm still holding what strike of put?
You still have a 100 strike put, Kurt.
That's right. Okay, so my at-risk amount is now what?
Well, it's negative. Your at-risk amount is negative because your insurance policy that you're guaranteed to get back is higher than your new effective cost basis.
Right. Now, I couldn't swap that one put for another put on the same day that I bought it. It doesn't work that way. Okay, the stock has to move before I can do something like this. But this is income method 3. It's one of the ways of bulletproofing the stock. Okay. Now, here's what happened. Okay, as we're headed into earnings announcement, I sent out a letter to my fishing subscribers. These are the folks that look over my shoulder and see the trades that I'm doing. Okay, and I said I know the future, which is funny. Why is that funny?
Because normally we say we don't know the future, which is why we're trading radioactively. We don't know what's going to happen next.
Right. But I knew my future. My future was that in the morning I'd be grinning ear to ear, because if that earnings announcement was bad and Research in Motion had an overnight gap of 30% like it did a few months ago, okay, that I still have already locked in my profit. I've arranged for a 3.55% profit, and I can get out without any problems. However, there is another possibility, isn't there, Mike?
Yes, there is.
The stock could go up.
The stock could.
And Yeah, what happened in this particular case was that the earnings announcement was positive, and the shares shot up to $119 and then started coming back down. And when it did, I sold it at 114.74. Mike, the total time in the position is 6 weeks, and I make a 16.23% gain. Not bad. Now, if I had sold a covered call, remember our example at the beginning, I'd feel like a chump because I'd be obligated to deliver that stock at $85 a share, and I'd make a much smaller gain. All right, but the fact is that the where a covered call would limit your upside, a married put leaves it open, but the really exciting part about it is along the way you can employ one of the 10 income methods and make yourself bulletproof to where you can't lose any money. Okay, so that's one of the income methods, and I think that's probably all the time that we've got. Let me ask folks what kinds of things impress you from today's webinar. We didn't actually show the adjustments of how to turn a losing trade into a winning one, so maybe you don't want to answer that one, but we did show one of 10 different income methods, and if you like the idea of having 10 different arrows in your quiver, 10 different tools in your box, that might be a good one to answer. If you like the idea of bulletproofing, if you like the idea of starting out with single-digit risk and yet still having unlimited upside in case you're right about the direction of your stock, these are really good, positive things. Okay, Mike, let me go ahead and close the poll and share the results and what's our winner.
Looks like bulletproofing, going from low risk to no risk, isn't it?
Yep. And then second place, a single-digit risk but unlimited upside. Listen, Mike, we've shown those two things. We've shown, first of all, one of 10 different ways that we bulletproof, right?
That's right.
And of course, the single-digit risk but unlimited upside, that's what we showed at the outset, okay? How to buy a stock, also buy an in-the-money put. It has a mathematical edge and an edge over buying long calls. Two different ways. One way is the fact that it forces your position size so that you don't take too big of a position.
Yes.
And secondly, that it actually prepays you the interest that you would normally have if you deposited into a risk-free interest-bearing account, right? It prepays that. Okay, let me go ahead and hide this. We'll ask one last poll, and that poll is, what do you need from us next? Okay, would you like to know what kinds of specials we are running for the blueprints? Would you like to look over a successful trader's shoulder? Would you like the trade simulator tool, which we actually didn't feature today? Would you like the Power Options Search and Destroy platform for finding these kinds of trades? Or perhaps the before and after tool that'll show you the different adjustments, what to do after getting into a position. And let's see, Mike, I'm going to go ahead and pull up the RadioActive Trading site so that we can direct folks to these things if indeed they're interested. Did any other questions come up that you think would be pertinent to answer the whole?
I would love to answer them all, but we're short on time. I've been going through and answering them as best I can. I'm going to forget some of the names, but I'm just going to address some of the ones that came through. A great one that is getting addressed right now is Russ just wrote in, and he said, 5 minutes before your webinar started, I did not know you existed. Please show me where I can get more info. And Kurt, you're going to show that right now when you pull up the RadioActive Trading site. There was a question that came in. I forget the sender's name. I apologize. I think I answered 20 questions in a row there in the last 10 minutes of the presentation. A gentleman asked, well, looking at that side-based position, you need the stock to gain 20% before you make a profit, but that's not true. If I held that side-based position all the way to expiration and made no adjustments, then yes, I'd need a 20% gain. But when you open an RPM, because your put is so far out in time and it does not react one-to-one with the stock, as you just showed with income method number 3, Kurt, I can have a gain, a reasonable gain in the first 30 to 45 days if the stock moves up in price, because the put is not going to decay and the stock's moving up more than the put is losing in value.
That's right. There's a misconception that if you buy a put option and stock, that immediately because you spent some money on that put option, immediately now your position is worth less because it's like driving a car off of a parking lot, right? Off the dealer's parking lot. It loses value instantly. Well, that's not the case. It does not lose value instantly. And the fact is, Sybase never did advance 20%, but we did make money on that trade, didn't we? It's part of the trading record. We made, I think, 4.1% or 4.5%, I forget which, but we made money on it. And the fact is, we never had very much at risk either. Okay. All right, Mike, I shared the results there, so a lot of folks would like to know what the specials are.
Go ahead.
But the second place winner is the Search and Destroy platform, so I'm going to show that first. Are we on the RadioActive Trading site?
You are, sir. Yes, indeed.
Okay. If you go to RadioActiveTrading.com on the Free Resources tab, okay, the Resources tab here, the very first option is to get 2 weeks of power options for free, and I would really take a look at this, not just for my strategy, not just for RadioActive Trading, but you support like 23 different strategies, don't you, Mike?
That's correct, yes. And for those of you just getting started, I mean, we feel that this is the way that you should be trading. And we have tools that support that, and I can help you with any of the other tools. But since we got linked together with Kurt, Ernie, the president and founder of Power Options, he trades radioactively. I trade radioactively and still apply some other collar positions as well, different collar positions. But I focus now on limiting my risk.
Yep. It's real flattering and kind of cool. I mean, knowing that you guys do condors over there, bear call spreads, bull call spreads, you do calendar puts, you do all kinds of different strategies, but RadioActive Trade is what the guys in the office use. That's kind of cool. If we look at this page further, there's the Trade Simulator tool on there, also a free tool. And the foundations of radioactive trading, we've got a webinar now that will go into great detail about describing how to get into one of these types of positions. And then finally, of course, the second place was folks were looking for what kind of specials we're doing with the blueprint. Trying to get over to that page.
A little hiccup there.
Now on the products page. Go ahead.
Well, that's loading. I want to say the important thing is, and I mentioned this to the gentleman I just answered, Russ, when he answered in about seeing more information. If you have not yet, the first step, of course, is just when you go to RadioActive Trading, over on the right, you see this free registration for getting the sketch. That's the first step. If you have not downloaded the sketch, it's Kurt's free 9-page white paper. It goes into the introduction of the methodology that we reviewed today and income method number 1. He showed you income method number 3 today. The sketch will show you income method number 1. You just get more for free there. No credit card required, but that'll really get you involved with this methodology and answer probably some of your questions.
Yes, that's a real good point. And again, we want to give away for free everything that we can. The blueprint over here is it's $289. It shows all 10 income methods, and the special offer that we have right now is that if you pick up the blueprint, you have the option to wait for as long as you'd like, and then try out fishing for $10. Okay, and fishing is normally $69 a month. It's where you get to look over my shoulder and see real time the trades that I'm doing with real money in the real market. We call it the R3 account for that reason. It's real money, real time, and radioactive. And so that's a special that we have right now. $289 for the blueprint. Give you all 10 income methods, and of course a real in-depth how to set up these kinds of trades and protect your downside while leaving your upside completely open. Okay, Mike, I think that's all the time that we have. So I'd like to thank everybody for coming, and thank you, of course, for participating. You're always a great help, and I sure appreciate it.
Oh yeah, and, you're very welcome. Here's an interesting concept. Just a question that came in from Mark, and Mark, thank you for sending this question. I haven't gotten to it yet. Mark says, I don't want to say the specific name, but he wrote it, so I could probably say it. But there's a specific section out there, a specific group out there that says they are the only ones teaching adjustments. It sounds like you are also. Now, it's not that we're also. Kurt, you've been doing this since 2002. At the time when you first wrote the blueprint, you start off with 4 income methods. That became 6. We've been teaching the 9 different income methods for about 2 years now, and the 10 different methods for about a year. You know, we added the 10th one. It's just using a specific type of stock. And we've been teaching these adjustments. Kurt's been doing this for years. I've been doing this with Kurt for 2 years. So it's not that we are also, it's that we've been doing it from the beginning. This methodology was not just about getting into a married put or a protective put position and then hoping the stock moved up. Kurt had it in place from the beginning with the income methods in place.
Well, thanks, Mike. I I don't like to get too vocal about it, but certainly the first copies of the blueprint were made available. They were pre-sold in 2002 and delivered in April of 2003. And some of the first recipients of that invited me to come out to MIT to lecture, and that was a real good deal. But there are certainly in existence lots and lots and lots of hard copies of the blueprint in which we've been teaching these spread trade adjustments for a number of years. So. So yeah, if someone else out there is claiming that, hey, we're the only folks who do this, then you might write them and tell them they need to do a little fact checking. So you know what? I don't begrudge anybody teaching this. I think it's a good idea if folks are teaching this, and some folks have actually copied the radioactive profit machine and called it different things, and that's fine. What I want is for the public to get this information so they don't get hurt as badly as I did when I was without it. And okay, well, Mike, that's I'm sure enough. Let's go ahead and close it up. And if anybody has a question that we haven't handled regarding the methodology or regarding well, anything about the services or products that are offered, or just any concepts or ideas. Please write us at support@radioactivetrading.com. And Mike, thanks again for coming. I'll thank everybody that's still online. Thanks for your time today, and I hope to see you out there. Happy trading.
Sounds great. Take care, everyone.